Welcome everyone. How we doing? Rudy, what's going on? Got a feeling this is going to be a real tiny class today. I don't think too many people care about trade smart. Oh, doing good, doing good. Uh, no, not me. No Vegas for me. Welcome everybody. We'll give it a few minutes. Like I said, I got a feeling this will be a pretty small class overall. How'd everybody do today? Just doing a couple things real quick and we'll get going. Okay, second. Okay, welcome everyone. How we doing? Give me 1 second.
What up, River Boy?
Oh God, Norman's here.
Yo, tell me you're
you
on the
can hear me?
Cowboys today, bro.
Marvin. George, how you doing? George,
Oh, okay. I didn't know you could talk on these things.
yeah, lately I've just been leaving it so the mics can be unmuted.
Oh, that's cool.
Yeah, I think it's better.
I love to hear myself talk.
I know. I love to hear you talk there. Dude,
I'm, ab-
that
I'm about to do,
Apple went on a heater into close. Big old
man.
buy. Big old
Yep.
buys on that thing is insane.
Spy did too.
Yeah. Yeah. Everything decided to give a nice little pop.
I had
Yeah.
11% day today. I'm happy.
Nice. That's a sick day. I shorted somewhere around here, got blown out.
Yes.
Got blown out. Saw the market on close, bought calls right here and sold calls right here. So I made well, the contracts are
Okay.
nice. I
You
did
know
like
when you bought that $28 call? No,
uh
put. You bought that put?
yeah.
I bought it with you, but
Some
then it went up a little bit, and I'm like, man, I don't have time. Let me buy a call because I thought it was gonna go up, but then it came down, and I sold it. So I lost on the put and the call, and I said, screw it, I'm done for the day.
yeah, yeah, that's really a good time to call it quits for sure.
Yeah.
For sure. Okay, well, let's get rolling. Welcome everybody. How you doing, Dirty River? Like I said a couple times, probably a really small class tonight. A few more people rolling in, but so as always, feel free to unmute those mics if you have any questions. Kind of talking about a more unique thing. Honestly, something that if you're a scalper, a day trader, hedging does not really come into your type of trading at all. I swing trade a lot. I obviously don't talk about it nearly as much. We got plenty of people alerting swings and day trades and all that stuff. So I do a bunch of scalping, a little bit of day trading here and there in the voice chats. When you're scalping, when you're day trading, I'm going to put it out there, 90% of the time, don't hedge. You don't, hedging is not, in my opinion, how hedging should be done. Oh, and I guess I should say that again, tonight's class is on hedging, kind of unique. But hedging is not for shorter term trades. If you're in a day trade and it's going in your favor, hitting your targets, you're trimming, don't buy a put just to hedge your day trade. Let your day trade work. When the trade's done, the trade is done. Hedging should be done for protection. There's basically no reason to ever hedge a short-term trade, a scalp or a day trade, because there's a very good chance you're going to end up just diminishing your profits unnecessarily. And it's fine once you've trimmed a little bit, you can widen out those stops and let the trade work a little bit more, never giving back all of your profit, of course. But you don't want to just put a hedge on. If you think the market's going to keep going in your favor, just stick with your trade or exit your trade and look for a re-entry. That's always what I'm going to recommend anytime short term, any shorter term trades, even, really short term swings. Really no point in hedging. 9 times out of 10, again, that's a completely made up statistic, but 9 times out of 10, you're going to be way better off exiting and looking to get a better entry on the trade. When what we're going to be discussing tonight is hedging longer term positions, whether it be shares, whether it be, long-term option swings. We've been seeing more and more swing trading in here, with some longer term contracts. I'd love to see people, finally buying time and actually letting time work. However, I'm seeing one side of it that's really, people are letting themselves get hurt. Yeah, exactly, Scott. People are letting themselves get hurt unnecessarily. And so what do I mean by that? Say you're in a swing trade. I don't know what to talk about. I should probably think of a chart to pull up, but we'll just talk for a second. Say you're in a swing trade and Norvin left, good deal. You're in your swing trade and it starts going against you. And you have time, and that's what people keep doing with their swing trades recently. They let the market go wildly against them, watch it go wildly against them, worry about their trades, all of these things, as opposed to just acting. And so when you're in a swing trade and you've made the decision that, like, I don't want to say that you're running no stop loss or anything like that, but you're looking for a bigger move. You're going to let the trade work. Trade against that position. And so with that, we'll start talking hedging. This is, something that I think anybody who's a swing trader, anything like that needs to know. And this is, to me, the most beneficial thing you can do with hedging. And so you have your long-term swing trade. Oh, I actually got a great chart for this. So you have your long-term swing trade. We're going to talk about Tesla because, everybody's trading Tesla and everybody wants to be bullish on Tesla. I'm not overall bullish on Tesla, but everybody wants to be bullish on Tesla. So maybe you buy this breakout. And the market goes against you pretty good. Well, you don't just have to sit there and watch your contracts get obliterated and worry about it. I know a lot of people, and we aren't touching on this tonight, but I know a bunch of people get way too heavy. They do these things, they get into trades that their portfolio can't support in the first place. And so they just sit and they panic and they watch their trades. Well, I think Tesla is one of the greatest examples ever because people just suffer through it as opposed to acting on the chart. So when we look at Tesla right now, and I've been preaching this here for a long time, one of the worst places to be getting long on Tesla is really anywhere in the 340 to 350 zone. We know just historically that is a trouble zone for it. This whole area right here is a trouble zone. If we get above it, great. We can take rippers. Doesn't happen often, or when we get below it, we dump. So what we know is being long really below 340 to 350 is not a good idea. Well, I know a lot of people they were trading Tesla, they were looking for this move, and a good friend of mine was in this trade and he did exactly what I'm talking about. He entered here, somewhere around here and fair enough. You're buying the break and retest of this. To me, you were wrong. So you have to exit your trade here. That's how I would trade this personally, especially on something like Tesla, because you don't want to wind up in the situation where Tesla drops $20 against you like it did, and of course came right back. Tesla loves to do that kind of thing. Well, then the market started flying, or Tesla really started flying, took that big old ripper, pushed up, pushed up, pushed up. This is where we really need to start thinking about our position and not getting sucked into trade floor, not getting sucked into people's wildly bullish theses on Tesla, even though it's done nothing for years. And so we know where we don't want to be long. So if we are long in this position, we want to watch this trade. And this is where we want to start managing our trade. And this is where we say to ourselves, okay, we've pushed up to one of the strongest places on the chart, a place where we know we don't want to be long. There's not a worse place to be getting long. Don't get me wrong. You've also from the lows 314 to 354, you've caught a $30 upside move. I know a bunch of that move was obviously just getting you back into profit, but you caught a very substantial upside move. You hopefully have been trimming on your way up and, ignoring the bulls, as you should. Then we see we're pushing into a trend line. Now we see all of a sudden after, a nice strong open to this day, we see a very weak close and we see a close under 350. Now is when we say to ourselves, I want to hedge. This is the spot where you put on a hedge. If you're in those 2-3 month out Tesla swings, you're up nice. You obviously need to have your stops moved into profit when you've caught a $30 move in your direction. But you say, hey, I want to continue to let this work. Bigger picture Tesla. Well, bigger picture Tesla's in an uptrend. Even bigger picture Tesla's in a downtrend.
Happy final.
Yeah.
Jan 4. Happy
Even
final.
even bigger picture, Tesla's in a range for 4 years. So we know we don't want to be long at the highs of range. So this is where we put a hedge on our position. Of course, still running a stop loss. When we hedge, this is where we'll kind of get into, the nitty gritty of it. When we hedge, you don't want to hedge your entire position. And so what do I mean by that? Oh, no sweat, man. What do I mean by that? We want to hedge a small part of our position to protect some of our profit. A hedge should never be treated as a trade. And so this is where it's going to sound crazy to you because a hedge is there to protect profit. So in an absolutely ideal world, the hedge goes to zero. I know it sounds very weird to put on a trade that ideally goes to zero, but the idea of that is say you have, whatever it is, a $1,500 Tesla position, you're up really nice. You want, and maybe it's gone to $2,500 or whatever. you want to hedge it. So you're going to put on a $200 hedge, something like that, an out of the money Tesla put to just protect you around this 350 zone. Worst case scenario, we bounce above these highs. You're going to stop out of that put for a loss. However, your contracts are going to make a bunch of extra profits, so you don't care about the loss. That's best case scenario. Your hedge becomes unnecessary. You're able to close it because the market continues in your direction. It is only there to protect your trade. You need to expect to lose. You need to want to lose. And so why would you do this? If you're just thinking you're going to lose money for when this type of situation arises. We know we have, nice three push wedge here, statistically kind of a bit of a bearish thing, pushing right up into it, massive 350 resistance that we were able to spend, all of 12 hours above, something like that. So we want to put on a hedge here. As I said, we break some new highs. We continue the direction we want the market to go. We stop out of the hedge. And our HAP doesn't matter. It is a loss that we should be happy to take because that loss is being covered on the long side. No big deal. Or you wind up in a situation like this where Tesla decides to crater as it likes to crater, and your hedge actually turns into what is a very profitable trade. And not only does it cover any of the profits you're giving back, but it also gives you a little bit more. And so that's why you want to hedge. You want to protect those profits. And then what do you do with it? As I said, maybe this is a longer term Tesla swing. I obviously don't think you should have held for a $25 pullback or whatever it was. But maybe it's a longer term swing. You really rode your puts down. You're nice and happy with it. Well, now you have some money in the bank. And so what do you do with that money in the bank? You can roll it into the position so that that money continues working for you. And you know that it might be an average up, it might be an average down, it might be whatever it is, but you can add that profit into that position, knowing that that chunk of it is financed. That's house money that you are putting into that trade, so that maybe if Tesla, bounces, and this was the trend that me and my buddy were talking about. He ultimately did catch some shorts down to the trend, exited the shorts. He did hold his longs the whole way, even though I begged him to stop out, but added to the longs here, and now has, on the pop yesterday, had as much profit here as he did up here by adding to that position. And so this is how you want to trade them. You don't keep them on all the time or anything like that. That was kind of what I mentioned in my post, starting this is hedges you don't want to do all the time, because if you're having to hedge trades all the time, I think there's an issue with your trades. Hedges are best used when protecting money you've already made. And that is, to me, the ideal time to do it. If you find yourself, having to hedge a lot of your swings because they're going against you, then you really need to be looking at your entries more than anything else. Oh, I see a couple of questions in here. So when do you hedge versus an average down? So you never average down unless it was part of your trade plan when you first made that trade plan. So you can say, I'm buying a half position for $100. If it goes down to my next support, that's where I will get into my full position. Maybe there's $75 then. So you're going to add to that position as you planned. If your plan before entering the trade had no average even considered in it, then you never add to that trade. If you're adding, you're likely somewhere around your stop loss, and you really should be considering stopping out. If it's a shorter term trade, you really should be considering stopping out. The only time that I'm ever really going to add to longer term swings is when I'm rolling profits from those shorter term trades against it, which gets me into this next question here. Similarly dated or shorter dated for sure. If you're in some, I don't know, I've seen people buying crazy shit on Tesla. Maybe you're in some, 6 month out 500 calls on Tesla or 400 calls. I don't know, some way out of the money Tesla calls. And we push up to 350. Well, you're going to want to trade, some 2 week out of the money Tesla puts. always shorter dated, because you're trying to capitalize on a potential short-term pullback. So, and it's not a trade, it's a hedge. So you need to find a reasonable enough contract that is a reasonable amount of your original position. As I said, maybe you've got a $2,000 position, so you're going to go looking for a $200 hedge. And that's and a shorter dated hedge so that you can capitalize on the short-term volatility and then either roll the profits back into the trade or book the profits and be happy that you booked a little bit of profit, you protected the pullback on your major position, and you let it ride. And so we've mostly talked about option trades, and options are risky because, well, as we all know, options are very risky. They have a lifetime. And so one of the big issues of using options to hedge options is that there is the chance that you get burnt both ways. It's why, strangles basically never work on ER because you almost never get a big enough move to cover both of the contracts. Of course, there's times and places you do, but for the most part, a strangle is never going to work that good on an ER, because you get burnt both ways. So you want to be very cautious when hedging that you don't just get burned both ways. You know, Exiting and repositioning is almost always going to be the better idea. However, what is one of the best things to hedge with options? Shares. If you are if you hold shares, if you have a long-term portfolio, maybe you trade in the same portfolio, hedge those shares. You're going to have long-term gains on those. You're going to hold on to them for a very, very long time. There is no reason to watch large pullbacks in the market, or even, I don't want to call it a hedge, but trading with the market. Like if some good volatility is coming and you own shares on something, trade some upside options. If you expect a little pullback and you kind of want to, hedge your shares a little bit, trade some options against it. It's one of the, big time, big money people. That's one of their very big uses of options, not only selling premium, but hedging the positions. Use an option, it's a derivative that can give you a nice multiplier on a smaller amount of money to really hedge those positions. And then again, you take your hedge money, you roll it into more shares. That is, that is the cycle that everybody should really work to in trading. You scalp to fund your day trades, to fund your swings, to fund your shares. That should be the chain of money in your account as best you can. And so you want to you want to just protect your money. That's what a lot of people forget in trading. And the people looking for the home runs, or the people looking for more alerts than the 30 that are given every day in OOT. Those kinds of people are always going to have a hard time, because they can't just let things work. They can't trade things. They can't watch very few things. And that's what we as, traders and potentially investors need to do, is protect our money. Nobody cares about the home run hits. Nobody cares about the 1,000%ers. Nobody cares about that. They might tell you good job one day and they're all going to forget it the next day. And so remember, you're always trading for yourself. You're always trading for your own money, and it is your own money. So protect it. And that is what the main purpose of hedging is to hedge those, hedge your bets, protect your money. Our job as traders is capital preservation. That is the number one thing. We need to lose as little money as possible and make as much money with as little money as possible. Those are our goals. We don't want our money going down. We only want our money going up. So we need to do everything in our power to protect the money that we are making. And that's one of the great tools with hedging. Another thing you can do. So obviously we've been talking Tesla tonight, and talking Tesla puts, because generally speaking, when you have a long position on an individual name, the best form of hedging on it is going to be just through, trading that individual name. However, a lot of people won't just have one thing in their portfolio or two things in their portfolio. Oftentimes they'll maybe be overweight in a sector. So one of the sectors that, me and Tilio have been talking a lot about really since election times last year, obviously got throttled in April or March and April, just like everything else. But the financial sector, I know that me, Tilio, I think Shark, a bunch of us, and Nando as well, he called Bank of America early. We've all been telling people, buy your shares of Bank of America, Wells Fargo, Citi. We were heavily recommending the banks on that big pullback in, March, April, because they were some of the things that you would expect to outperform. And so now, as we've seen XLF, I mean, I looked this up this morning for Norvin, I've already forgot. XLF is up 28% off the lows. So putting in an absolute ripper, very, very strong sector, setting highs before some of the other, while some of the other sectors are not setting new highs just yet. And so very strong name. So maybe, or very strong sector. So maybe your portfolio, if you've been, listening to, and it's not just me until many economists out there that are much smarter than myself saying the same, that financials were a good sector to be overweight in for the last couple of quarters. And so maybe you're overweight. Well, you don't want to have puts on JP Morgan and Bank of America and Citi and everybody. And so that's when you can go to the ETFs. And obviously XLF is going to be your financial sector ETF. And so this is what you would hedge with. If you are trying to, hedge the financial portion of your portfolio, you're going to go for something like XLF because it's going to kind of give you the all-encompassing thing. And we know if a few of those big banks are pulling back, then XLF is without a doubt going to be pulling back with them. And so you can do this for anything, anywhere that you are. You're tech heavy. You're Apple, like everybody is. Apple's, Microsoft, Google's, Amazon's, all of those. And we're coming to a point in the market where a big pullback could come. QQQ, no brainer. If you hold Apple, Amazon, Microsoft, Nvidia, you hold QQQ basically. I mean, that's what 30% of the Qs or something like that. And so you can hedge with the Qs. And again, you are planning to lose money. You are planning on all of those things. QQQ is a great example. Obviously, big buying the last few days, absolute ripper this week. And now we're coming into, not only big daily trend. I think we're probably over this even. I think we're moving in the after hours. We're coming up to big daily trend. We have big data coming out tomorrow. I could not think of a better time where if you have a tech heavy portfolio, it might be worth it to throw a little hedge on and hedge. The market could pull back on bad jobs data. They set us up, technically speaking, they've brought us to a really great point where the data will either break us out tomorrow or fake breakout and dump, or dump us tomorrow. The two main options are breakout or don't break out and reject tomorrow. So you have a tech heavy portfolio. This is a wonderful place to put on a little bit of a tech hedge and see what happens, because if it doesn't work and you lose money on the hedge, great, because that means all of your big tech holdings are absolutely running. And so that's how you want to hedge. I've been getting a lot of questions about it lately. And because we've seen, some swing trades, not only member trades, but some of the alerts as well, staring down some pretty big drawdown, and so that's what I really wanted to talk to people about. If you are, if you are, uh, you know, if you're in a swing trade and it is going against you, then don't just let it die. Yeah, Raphael. I mean, great question. It's really up to you. Me personally, because you have to think. So you say you got 10,000 in QQQ. What is that? 20 shares these days? Something like that. Is that it? I don't know. Not a ton of shares. Put on $100 or $200, $100 or $200 hedge, a cheapy at the money. Well, not cheap, but bigger picture, cheapy at the money put. It's going to cost you $150 or whatever it is. I mean, say QQQ pulls back $10. You got your 20 shares, you're going to be down $200. Well, if you have that $200 hedge and QQQ only pulls back $3 or $4, you are making money, so the risk reward will just favor you there. You don't need to do, some massive hedge on it, but you need to say to yourself, okay, I got 20 shares of QQQ. What's the most I think QQQ could go down tomorrow? Say $5 or whatever it is. So you're like, okay, that's $100 risk in my head or whatever, I'll put on $100. I'll put on $100 hedge. So it's more about, you analyze the market, you think what this data could do, and you trade around it. And so just to get back to this, swing trades. And this is the part that this is, final, final part of all of this, because it's not what we're going to talk about now is not necessarily hedging. And we touched on it a little bit with Tesla. It's not necessarily hedging, but it is quite literally trading against your position. So a hedge, you're using it, as I said, ideally hedges are being put on green trades. You don't hedge red trades. If you are making the decision, and ask yourself, always look at the chart. If you are making the decision to hold a trade, even though it's going against you, you've, for whatever reason, you've decided, okay, I'm going to keep holding this trade. Yes, it's going against me. I'm accepting that risk. And for whatever reason, I don't think it is a better idea to stop out and reposition. That is when you are going to trade against your position. So we'll just make up, I don't know, another random one. We're going to go AT&T. So AT&T, yesterday, or no, 2 days ago. Okay, so AT&T, we know this 2930 is a huge level. Maybe you're long on AT&T, and we're pushing up into this 2930, and we say to ourselves, this is going to be a tricky spot to get by. We've already kind of had some rejections here. When we draw this wedge up, we know that we're pushing, right up into this wedge. I'm long AT&T, but I think it's going to get ugly. I think we could take a nice little rejection off of here. I'm going to trade this. Maybe I put that trade on, I bought the close the day before and I started to say, God, I bought calls at resistance. I bought a double top. I did things I shouldn't have done. So I'm going to trade against this position. Even though I'm not green, I'm still longer term bullish on AT&T. So I'm swinging long on AT&T and I'm sticking with the trade. Well, we know this is weakness zone. I'm going to trade this as normal. And I think this is one of the most important things you can do. And you got 6 weeks time, you got 2 months time. Trade against your position. Don't just, like if you're getting smoked, but you're still confident in the trade long term, you're prepared for the pain. Trade against your position. Do not just sit there and watch it die. Do not be the person on trade floor saying, I'm down 60%. What do I do? What do I do? Well, you have to ask yourself, what did you do while you lost 60%? You sat there and watched it sell. So on AT&T, you trade this, and I'll trade my normal day trading position or scalping position or whatever it is. And this is if you take anything away from the hedging thing. When you are hedging a good trade that is working, that you want to stick with. That's where I think hedging should be involved. Coming to inflection points in the market, you want to stick with the trade, so you put on a hedge. If you're just holding a trade minus 50%, minus 60%, I don't care if you're the most confident person on the world. I don't care if you post all these charts saying, look at this, look at this, look at this. I'm still long, and you're watching your position die. That is not good trading. That's just arrogance. That's greed. I don't know what that is, but trade against your position. So on something like AT&T, we know we bought calls at resistance. We'll trade our position down to our level, short this 2930 down to 29. We will continue to trade this position. Next day comes and we can't do anything around 29. I'm very willing to short this again, back down to the next level. Now, when we start to see a bounce, we see bounces off our levels, we see strength, we start to see, we pull up some longer time frames, we start to see some reversal candles forming, we start to see buyers showing up at a level where we want to buy. This is the point where if our plan, if our plan had an average down in it, this is where we average down. If our plan didn't have an average down, but we've made money trading against this position, then we can add that money to this trade to get ourselves to a better cost basis. So this is kind of circling back around to averaging down. So now you've traded against your position and you've added to your position. Well, there's this gigantic misconception. And, I hate how people average down and I hate how people treat average downs. They don't do it for any reason. They'll say, oh, I trust the analyst or whatever. Like it's the worst reason ever to average down. Average down because the chart tells you to. So when you average down, you aren't adding more contracts to make more money. You are adding more contracts to reduce your cost basis. So let's say we got, $500 or whatever it is in T. And now we've gotten wrecked for a couple of days, but we've traded against it. Maybe we're down $200 on these T calls, but we've, made $100 short in this thing. Well, now, yeah, Cassius knows that I've been doing on AES. And so, now we have some money to average down. Maybe we've made, $150 extra. We get to chuck it into this trade. We get to reduce our cost basis. Once we go a little bit green, we take the average down off. So, say we buy the contracts at 20, we add more at 15, our new average is 16. When we get up there to 17, $18, we're taking that average off. It's not about making money. So now we take that average off in a little bit of profit. And if it ends up breaking down past here, we get our little bounce, we take our average off. If it ends up breaking down past here, we know that's our stop out because where you average down needs to be where you would stop out because then your stop is very tight. Well, we booked the profit, we booked the average down. So even though we might go, red on the remaining contracts, because of the profit we booked, we're walking away with a break-even trade, as opposed to having to watch this thing die, post on Trade 450 times about, I hope it bounces, I got the house on this, and then get saved. That's not real trading. That's gambling. Shark and I were even talking about it on Trade 4 the other day. If you're averaging down for no reason or you're averaging down because you're red, then you're gambling. You aren't really trading. You need to have a plan. Otherwise, it's never ever going to work for you. And so really that's about all I got on hedging. Like I said, might be a short lecture tonight. But do you guys have any questions? It's a pretty straightforward thing. You hedge good positions. You trade against bad positions that are going against you. That's the gist of it all. Again, when you're hedging a position, you're only maybe going to do 10%, 10 to 15% of total position size. And you are ideally going to lose money. Because if you're losing money, you're making more on the 90% of your position that's not hedged versus what you're losing on the 10% of the hedge. And then again, when you are trading against a position, you're actually trading. You aren't like, just hedging a little portion of it. You are putting on a new trade that if you make the decision, you can roll that into your longer term trade. Does everybody get that?
Yeah. Quick question. I don't know if this is a different class or how it ties into it, but thank you for all that information. That was amazing.
Yeah, of course.
Adding to your position, right?
Mhm.
And I'm not necessarily talking about hedging or whatever, but there's times where people are trading, they're like, yeah, if I get here, I'm gonna add to my position. Does that tie into all this, or I don't understand how to do that because I'm
So
always, yeah.
so if you are just holding the trade, like so right now, Shark, we'll use Shark as an example. I try to not talk about other people's trades generally, but Shark alerted Starbucks today, half a position, waiting for confirmation of his support hold, and he'll add. If we dip, he has a spot where he wants to add. And that's even what he says here. Expect a second entry as well, because he's saying this thing could go a little bit red. So he's buying, people ask me about this. It's a perfect setup on Starbucks to get in there again. And so he's leaving himself room to add. That's part of, his plan. So he's not going to trade against it. He knows what his plan is. He knows exactly how much he's risking. He knows how much he'll add at that ad. And so that's all part of his plan. So adding to a position when it's part of your plan is fine. Adding to a full position is never fine. If your plan involves adding, that means you aren't buying a full position. You are buying half position or whatever it might be, with the plan to add the other half. Maybe you're going to buy two of these contracts for $440. And if it dips back down, you know your normal position size is $800. So you're going to add the other well, or not the other, probably 3 or 4 contracts or whatever it is, but you're going to add $440 more to that because you had a half a position to start. Now you have a whole position at a slightly better entry. I'd seen a question up here too. Somebody asked about time and sales, and I don't see it right now. If somebody posts it again, I'll answer your question.
So, River, let me ask you this. What do you think about hedging with some of the like 2x leverage, like TSLL for Tesla? Uh,
Uh,
I know it probably is a wash because the delta is going to be different and it's basically just going to adjust itself. But
yeah, the biggest issue is it likely will not offset the loss. You could offset more loss with less capital on options. And so, you don't, I won't say hedging, SQQQ, all of those things, but you need to start thinking in percentage to percentage relations. And, you might get a, maybe Tesla drops 2% or 1% or whatever it is, and your TSLL is you're only gonna get, you're going to get 3% on your shares. And so if you only have 10% of, 10% of the position hedged, you're only going to make 3% on those shares, but you're getting a pullback, a big pull, a 1 or 2% pullback, whatever it is on Tesla, it won't quite offset it. I won't say it's wrong, and I won't say you should try to ever, have a big enough position to cover the whole loss, but the risk reward, I know that might be a weird way to think about it. You can do more protection with less capital using an option. That's why, that was kind of a big purpose of options in the beginning was, well, to give people bonuses and to hedge some portfolios. We're hedging 100 shares basically by buying one for real cheap, pennies on the dollar. Let's see.
So if you take, let's say you take you're scalping, right?
Mhm.
And you buy one contract of Apple,
Mhm.
and it's a call, and it starts going down about 10-15%, but then there's a spot that you think, okay, it can bounce here. That's where you would add to your position. Or do you add to winning trades, like a trade that's from
No,
the get-go
I,
is it's
I'm pretty opposed to so what you said, the first example, that is where you add if you knew you were going to add there before you bought the first contract. That's the big part of adding to any position is it needs to be part of the plan before the trade is entered. Maybe you're going to say I'm going to buy AT&T calls at 29 and if we drop to 28.57, I'm going to buy more. That's fine. If you buy T calls at 29, full position, and we drop to 28.57, and now you have to dump in a whole bunch more cash that was never part of your plan, that's what you don't do because you're just getting too exposed. So it's all, you only add to positions when you plan it. And
so
ideally,
almost like
or I was
so
just going to
almost
say,
like you're saying,
then you don't, you know, when you've planned it, that is the only safe way to do it. Because if
okay,
it's not part of the plan, you're just praying. You're just you're just buying more because it's red. You need to plan it ahead. Where the negative side of that is, and I won't even say this is a negative, is maybe you buy the half position and it works and you never get to add your full position. That's just the way it goes sometimes. You don't like you won't always have the full position for the winner is what I'm trying to say here. Anytime you're swinging, you should always leave room to add more. Full positions right off the get-go are
okay,
just,
okay.
not good.
So is it? Could you think of it like sometimes maybe you think, man, this is a good entry point, but I may be going in a little too early. Could you
Yes.
think
And so
about it
then you
like
gotta
that?
have
Okay.
position. And you guys have probably heard me say it in voice chat where I say, hey, I'm gonna get my foot in the door here. These might get wrecked, but I'll tell you when I'm adding more. So there's times and places to add more, and maybe you do take that really small position to get your foot in the door. Happened to me on something the other day, though. I mean, I bought two of them a couple days ago. And then those things ran like 600%, 500%. And, I had sold my two that I had, so sometimes you don't have the whole position to hold, but that's just the way it goes. Then as far as adding to winners, almost never. Because when you add to a winner, you're increasing cost basis and you're increasing risk. And adding to, like, I know there's a couple of the psychology guys out there, Trader Tom loves to teach it, add to winners. I mean, people who add to winners are full porters. I mean, I've literally watched a video of Trader Tom full porting a $300,000 account into a trade, saying it's fine. We're adding to the winner. We're adding to the winner, and then take the stop around break even because they added. He was up big, and he kept adding and adding and adding. Then it went against him, and then because his cost basis has gone up so high, a small pullback put him back to break even. So trim your winners, let your winners run, and look for re-entries. You'll make more money that way for sure. Yep, time and sales is well, I mean, it depends what you're looking at. You can of course watch time and sales on options contracts, but they don't move very fast. But yep, time and sales, if you pull it up, for something like AT&T, well, no shares are being transacted right now. When you pull it up, on your individual names, then it's for that. But if you're looking at an option contract, say you're looking at an option contract, if you pull up these 649 calls, then they will have time and sales as well, and it will be telling you it for the option contract. Yeah, Raphael, that's a big part of it, is just understanding that, you're taking the potentially early entry, and that's why you want, that's why you've left room to add to it if you need to. So Harrison, that's a good question, but almost an impossible one because to answer because it's so trade by trade based. You like if you're when I swing and when I day trade and when I scalp, I trade extremely I trade extremely reasonable strikes. It's funny because I did have some pretty far out of the money Teslas, but it was the plan. I trade reasonable strikes and I run tight stop losses. Generally speaking, if a trade has gone so far against you that your strike price is now unreasonable, that's a trade that should have been stopped out of and likely not something that you should be adding to. I don't know, say you're in 300 Tesla puts for this week or something like that. And, Tesla keeps going up. You don't want to be adding, like, your strikes are so unreasonable. Adding to them will do nothing for you, and you just got to exit and reposition. Is going to be the best thing because 90% of the time you don't want to be averaging down on any trade. Long-term swings, your long dated stuff is a bit of a different story. Like I said, you should always leave room to add a little bit at least. But anything shorter term, if all of a sudden your strike has become so unreasonable that you were questioning it, you should likely exit that trade and look for a better entry. Don't just keep adding to the wildly out of the money strikes or anything like that. So I believe what he was talking about, Scotty. So people talk about adding to your winners, okay, like, I don't know. So maybe you're in spy calls today or whatever. And we push up, people might buy more right here or buy more because they think the breakout's coming. But where this was their break even, now they bought more. So up here is their break even. So people do it, adding to winners. On a day like this, it works out great. On something like this, if you were adding to any of your winners, your shorts, you got demolished by the end of the day. So you are always, in my opinion, better looking for a new entry. Yep, exactly, Scotty. My hand was sort of forced to become a full-time trader. I mean, it was something I dabbled in for, I don't know, 15 years or something before. But then my hand was a little bit forced, had some things happen, and I was like, well, I know how to do this. I guess this is what I do for a job now. But I was lucky. I mean, I'm self-taught. I can kind of say that. because I learned basically everything myself. I obviously was learning from people. I didn't just sit down and learn how charts work. I learned from people. But I traded shares for years before I ever touched an option. And so I was really lucky. I understood how charts moved. I understood how shares moved. So my learning curve into options was smaller than many people. So, when I started doing them more and more in 2015 or 16, 17, I don't, 2016, uh, I had a shortened learning curve. And then, I mean, don't get me wrong, I got wrecked a few times, had to learn a little bit about how options worked. But then scalping is just something I've really got into in the last like 5 years, 6 years, something like that, because it's fun. I like to do it. Learned some from, was doing all right at it, learned some stuff from Tilly when I joined, and I like scalping. I've always thought it's fun. 20%, 5 minutes, man, it's a hoot. Like I have a good time doing that. So I never really had this like aha moment. I was just sort of like, okay, I guess I trade now. Yeah, exactly, Raphael. Let's see. So if that's it, I mean, if I answered everybody, um, no, Avenger, I mean, there's no point. I mean, I'll tell you what, I don't know about that, Avenger, and I'll tell you what, Crash Misnaps, I'm in a swing trade right now. I would be getting, I would just be getting torn apart all day, every day. I mean, at one point today, we were not looking good. I mean, we were really not looking good. I've had to do a few ads to this trade, I'll tell you what, but thankfully by the close, we were roasted and toasted, but I'm sticking with it. I got the thesis. I got everything. I like this. I can't lie. I like how this worked. We'll see how I feel about it tomorrow. But people don't want anything to do with that, and then so like, we have too many swing trades as it is. But I swing things, I swing all the time. Um, but we don't need more swing trades, because that's the issue. Like all these people keep asking, uh, you know, all these people keep asking for like, more swing trades or whatever it is. It's not good. Maybe you take some swing trades from me, and then you take some from Shark, and then you take some from Nando, and then you take some from Luigi, and then all of a sudden your whole port is in swing trades because they were alerts or whatever. That is bad. You should never have that much exposure, because what if it goes wrong? Like it can destroy you, and so the last thing we need is more swing trades. But I talk about things I'm swinging and voice chat all the time. I mean, just yesterday somebody was like, oh, you still in AES or did you exit? And if somewhere right about here, I told them I am long and strong on AES, and then it dropped 7%. Yeah. Oh, was that you, Avenger? Yeah. And then it dropped 7%. I mean, the contracts were down. Well, I mean, it was all on the spread, and it never really got quite as low as like the bid was showing, but I mean, they were down 80%, 70%, something like that. So I bought a couple more. If he ends on the yield max ETS, run away, like MSTY and stuff like that. Yeah, run away. I mean, they got a big divvy, but so like I think this is a yield. Oh yeah, it says it. So, big dividend yield or whatever. I don't know what the one on this, like this one's probably telling you you're getting like 100% or something crazy. Maybe you're getting 100% dividend, but when the stock is down 90% and your dividend dollar amount is decreasing, well, you have shares from way up here, maybe you're break even, but you sure aren't too happy. These things are like I don't touch him. You can trade him for some leverage exposure. I mean, we did TSLY, TSLL, whatever the long one is for a Tesla earnings, or probably short, honestly. So they are a nice little, they can be a good little thing to trade at times of expected volatility, but they always do these things like, oh yeah, we'll pay you 100% dividend, and then you see you're getting a buck a month while the stock per share while the stock is losing $4 a month. So they're really, really tricky. The point of them is to get people to buy them, I guess. I'm sure there's massive premium sold against these things because everybody knows they're going down. I think there is like a Tesla one too. Yeah, I mean, imagine you own this thing at $18 and then now it's down to $7 and you've been getting, less in a dividend every month. I mean, this thing sheds $3 in a month and you got 70 cents for holding it. Oh yeah, there you go. For the insurer to make money on fees. Exactly. Yeah. Yep, I found. Thank you. Thank you for being here, Avenger. Thank you for being here, everybody. I appreciate it. We ended up with a few in here, so thanks for doing it. Yeah, there's a lot of them. I tell people to run away. I tell people to run away. Rudy, have a good one. Thanks for always being here. We got it. We got 5 more minutes. If you guys want to check out a chart or anything, you can just say yes chart and laugh at me. Yeah. Yeah, there's a ridiculous amount of. Oh, it is too. Let's see this one. Oh, what? You're telling me it's almost buy time, huh? Look at that. Do we buy it tomorrow? Dude, this could be a front runner for Friday fun. Some 42s on a weekly 42s. Do they even have weeklies on this thing? Some weekly 42s on ASTS off the open. That's wild. I mean, if anywhere to try.
Yeah, it's looking good. For
Oh
sure.
yeah,
I was thinking
Harrison, it
about
will
it
be added
today.
for sure. Sorry, Crash, what were you saying?
No, I was just looking at it today and it
Yeah,
looked appealing.
yeah. Get me back up here. That's sick one. It's honestly almost time to put on the swing. This is actually such a sick swing setup. I love this setup right here. We're getting like I'm sure everybody's calling it a head and shoulders. And so now we got to look at this and say, okay, sick triple bottom setting up for us. We buy this right here. We try to swing and catch the bounce. Otherwise, our stop is right below us. Little to no risk. This is like my swing. This is like if I could pick a swing setup. Oh, if I could pick even a 3-push wedge with the push out on one of the legs, range low. Wow. XLE, yeah, let's check it out. That thing's been like too strong for my liking. Let's get that back down. Am I right? What do we got going on here? Oh, look at that little sneaker. Wish I would have shorted that. Wow. Well, we see our line in the sand on XLE. We tried to break out of this range. This thing is just the most range thing ever. We know where we want to be short. I mean, you can short this thing tomorrow off the open. Stops over 90 probably. If you want a wider stop, stops over 91 in that trend, but I'd probably be looking to short this thing. I mean, you got to stay short on energy. Drill baby drill is terrible for oil. It's terrible for oil companies. So you got to expect them to go down. PCG. Let's check it out. Oh yeah, fuck this company. Sorry, pardon my language. Not a big fan of them. Honest with you. Hope they go down a lot more. Yeah, can't lie. Honestly, I could probably want a little more happy. Dude, I hate this thing though. I mean, we see where to buy. 1460 to 1480, probably the spot where you want to try to be getting in there. Then you can have your stops because it'll get back down to 13. Breakout and it could get it running. Oh yeah, some randoms here and there. I always be winning, but not really, man. I'm a day trader. That's why I don't care what companies do. And people are always like, can Tesla keep running? I'm like, I don't, who cares, dude? Just trade it today. Come back tomorrow. What company do I think will out of the S&P? I got no idea. That's another one that I just don't care about. Everybody just guesses. I talked about this in my show today. I don't care who you are. I don't care if you're an analyst in OT or if you think you're the smartest dude on Twitter or whatever it is. You are guessing. Nobody knows besides State Street. And so, I don't even, it's not even worth the guess. It's not even worth the guess. Not hood. Yeah, Avenger, have a good one. Yeah, Scotty, weird things always go on with XLE right at the open. Them oil people, all things oil are just they're icky. Rudy, I did one. I got a recorded one on feature somewhere, I think. Yeah, thank you. Thanks for being here. But yeah, I got a recorded one on features somewhere, I think. I mean I did a class on features, so it should be out there. Oh yeah, Scotty, all of them. You guys have all heard me. The market is not manipulated, at least how like people think it's manipulated. Like it's not. But there's a couple places that are heavily manipulated. And I'll tell you what, all things oil are a manipulated sector for sure. Those people are tricky, tricky. I think Lulu's gonna be my trade off the open tomorrow. Thinking some Lulu calls. I hope we get like a $5 knife down. Yeah, there you go, Scotty. I bet, yeah, yeah. That's a bad one. Yeah, I bet some Lulu calls off the open. Yeah, Lulu got just rested and tested. I guess I don't care. Calls or puts. Let's get a real volatile candle one way, and then let's do the opposite, and let's make some money on that thing tomorrow. There's another one. There's another one. Was this one? It put in a good move. Yeah, but it's nowhere interesting on the chart, really. We can probably short off the open, I guess, huh? No, I guess we're up. And we'll see. But Lulu, yeah, Lulu off the open. I think that'll be a fun one. Okay, well, if that's going to do it, everybody, thank you all so much. I really appreciate you for being here. Hedging class, I wasn't sure how it'd go. Hopefully, you guys learned something tonight. I know it's not the most exciting thing ever, talking about trades that you just want to lose money on. But thanks for being here, everybody. Really appreciate it. And we will talk to you all tomorrow. Friday, fun day. Have a good one. Catch you later.